Welcome to the Estates Made Simple podcast. My name is Jenna Carvello. I'm here with Gordon Vanderleek, and we are excited to talk to you today about all things estates. How are you doing, Gordon?
We're doing great.
Good.
As we're recording this, the weather's getting a little bit better. So enjoying some of these signals that maybe we're getting into actual spring, and with the weather changing a little bit, so it puts a little bit of a better mood, I think, for everybody, right? When we have better weather conditions and the white stuff starts melting.
Of course, I love it.
Yeah, and we get to talk today about taxes, right? As they say, the two certainties in life, death and taxes, which I guess is an appropriate context for a podcast talking about estate administration. And we thought, as at these early stages, it would be good to talk about taxes because it can be a difficult topic, or one that creates a sense of angst because people go, I don't even know what to do in this circumstances, and what are the tax implications. So we wanted to talk about it today. But let's just say from the outset that this is in fact a very specialized topic. You'll hear us talk about the need to get accountants and proper advice, and that's not us. So everything in this podcast, of course, is for information purposes only and doesn't constitute any advice regarding your situation, other than take from us the takeaway would be to go get that advice and make sure that if you are the executor, you want to cover your liability by ensuring you get a competent professional to help you with it. But the hope is, I think, in this topic is that we can, in fact, give you kind of the framework or some information on which to ask the right questions and identify the issues that you may need to get some specific advice on. So yeah, maybe a little bit of a background you can give us, Jenna, with regard to these things called tax returns and what has to be filed.
Yes, everyone's favorite topic. So when an individual passes away, there is a return called a terminal return that the executor needs to file. Now, this is the period from January 1st all the way up to the date of death in the year of death. So it could be for one day or it could be for 364 or 65 days. So it's important that the executor know the deadline for this return because it is based on when the deceased actually passed away. So, as you mentioned, get an accountant to tell you what the deadline is to defer your liability there. Estates also need to consider the income earned after death. And that is put on what we call an estate return. And that can be for a period all the way up to a year following death. So there are a couple of tax returns to consider, and the terminal return, of course, could be quite significant. And we'll dive into that a little bit further in this episode. But just be aware that there are deadlines, so consider those deadlines right away after the deceased passed away.
Yeah, and I think the point on that would be to do that at an early stage. I think sometimes
Yeah.
what happens is at the beginning we're focused on probate and setting up the estate account and starting to collect the assets or preserve assets and take stock of the assets. But it'd be important as soon as possible to make a decision about who the tax professional is that you're going to rely on to give advice with regard to the estate, and do that at an early stage. Yeah, so one of the things that I guess as a first comment to put out there would be to distinguish the taxation system in Canada versus that in the U.S. In the U.S., they have a thing called estate tax. So it may very well be, and this could be a subject of getting advice on, that if there's U.S. property or the person is connected to the U.S., that's a whole other issue of do you have to file a tax return with the IRS? We were talking about the returns you file in Canada, but in the U.S. they have an estate tax. The taxation system in Canada isn't that we have a specific estate tax that is a tax based on a percentage of what is in the estate. But with that being said, there is a tax implication to dying, right? That there's a deemed disposition of all of one's property. all of one's assets as of the date of death. So we have to go through and determine what are the tax consequences associated with that deemed disposition. And it typically is that if there's going to be a bigger tax liability, it's in that terminal return, right? It's in that final T1 return that you see a greater amount of tax. So if there is a surviving spouse or partner, there may be a rollover. And so that has to be considered. Do we qualify for a rollover, or would there be a reason why you'd want to opt out or exempt, get yourself out of that rollover? There might be some strategies there as well, but typically you're going to look at all of the assets that the person owns. So that could include an investment account, right? So if somebody has stocks or bonds, some mutual funds, GICs, different investments, right? Their savings, what does that look like and where was that invested? And it may be that you have to put the unrealized gain for those assets into that final return and account for it. It's not that you went out and sold that stock, but the law says it's as if you did, right?
Yeah.
So if you own shares in TELUS and you go, well, I haven't sold them. There's that share certificate. I still own 1,000 shares in TELUS. The law is you have to account for the capital gains that arose from the deemed disposition of those shares in TELUS. So you may not have the cash from the sale, but you have to pay the tax as if you did. And again, if there's a surviving spouse or partner, there may be a rollover, and the accountant can give advice with regard to that. The real estate is also another component where there is some potential tax liability. So you're going to take a look at any real estate that is not your principal residence. Of course, the principal residence in Canada, we don't pay tax on the increase in the value of one's home. But if you had recreational property or rental property or other investment property or property for whatever reason, anything other than where you live, that is your principal residence, what we would say, this is my home, then there has to be some calculation of any tax associated with this deemed disposition on there. And of course, shares in any businesses, if you had a corporation and owned shares in it, there again is a deemed disposition. So the rule is that you're deemed to have disposed, but then there may be a rollover if it's going to a spouse. The other place where there can be some tax, of course, is with the registered investments. We'll get into that, but there has to be this calculation of the gain. So even though property hasn't been sold, there may be a check owing to the receiver general to pay the tax as if it had been sold.
Yeah. Yeah, and interest and penalties start as soon as it's due. So as we mentioned, it's important to get that tax liability in to CRA when it's due. Even if you don't have liquidity in the estate, CRA doesn't care. So you need to find a way to get the cash to pay that tax bill.
Exactly. And specifically with regard to if in the state there are shares in a private corporation, there may be some planning that could go on with regard to those shares. So I want to highlight that as well, to say that you want to talk to an accountant and a lawyer with regard to any planning opportunities for restructuring. Those are typically time limited, and you want to make sure you meet you explore anything that is available to minimize the tax liability, because ultimately you have to report on that to a beneficiary. And if the beneficiary is asking, well, why didn't you explore, that pipeline transaction, or it's a possible transaction related to an interest in a business, well, you don't want your answer to be, oh, I didn't realize that. Right.
Yeah.
Then there's going to be some liability for it. So you're not expected to know everything, but you have to inquire. You need to have that curiosity to say, well, what about this? And again, the message from what we said in the outset is get that advice early on so you can avoid missing a deadline or paying penalties or interest or just missing an opportunity because the executor's responsibility is to maximize the value of the estate.
Yeah. Yeah, and so you touched upon, the deemed disposition of assets. And the second bucket we wanted to talk about of what goes in to a terminal return is really the income earned up to date of death. So that would be, standard investment income, it could be pension income, it could be employment income. And then it also would include, as you mentioned, your registered assets, so your RSPs, your RIFs. Anything locked in would come into your terminal return as income in the year of death. And so that's where the bill can really get high if you have substantial registered assets. Now, tax-free savings accounts, of course, there's no tax on the increase in value, but the RSPs and the RIFs and the like would have significant tax consequences, unless, of course, it's being rolled over to a spouse or a partner.
Right.
Um, so it can be quite significant as I mentioned, and you just have to watch to make sure your accounts are addressed in your terminal return.
And certainly in terms of any RSPs, for example, that are going into the estate, there can be a joint election to have those rolled over to a spouse, but again, that has to be filed. So
Yeah,
in some of the cases, there are specific elections that have time limits on them or things that have to be filed with CRA to make choices. So we sometimes
yeah,
refer to those as elections. So, the RSPs may be one of those. Again, you want to know that early on. You don't want to miss that deadline. In some cases, if CRA has a deadline, there's very often not an opportunity to do a do-over or say, oops, I missed that. Will you please forgive it? They're going to go, well, sorry, you missed it. That's all there is, right? And
hmm,
you don't want to have that as part of your report to the beneficiaries that, sorry, I missed a deadline. I just wasn't aware of it. So
yeah,
figuring out at the first stage what are the requirements, what are the elections, what's the potential tax liability. Those are all important things to know. So making that decision early on about who that professional is going to be will be important. The other thing is listening to you, Jenna, I was certainly over the last couple of years, we've had a number of cases where we have RSPs going one direction and the liability going the other. So I just want to, again, a little bit, I don't want to get too far into the weeds here, but I want to, for our listeners and viewers, really to highlight the fact that RSPs or RIFs are an interesting beast in that you can designate them to go somewhere, but the estate will bear the inclusion of the income of the unused portion of the RSP and the RIF.
yeah,
So again, if it's going to the same person, it doesn't really matter. But what if it goes differently, right?
yeah,
A case we had in the office was that somebody left the RSP to a friend, and all the tax liability ended up in the estate. And it did make the residual beneficiaries too happy to know, well, we didn't get the benefit of any of the proceeds, but we ended up having to pay the tax on us. So that reduced our inheritance, our gift in the estate. And there was lots of questions about, well, did the person intend that and
yeah,
the like. So it's a bit of a complicated area, and there's some interesting law in that, but you just want to be mindful of that from a planning perspective, certainly. But as in terms of the duties of the executor, also to determine who are the beneficiaries, right? And ask the institution, well, can you show me the beneficiary designations? It's part of determining, is it part of the estate? Is it not part of the estate? Does the
yeah,
executor control that asset or not control that asset? It can become important. So yeah, there's sometimes some fights over that, right? As to
yeah.
who should be paying the tax with regard to that. So
Yeah, that's a great point because I think it's often surprising when executors learn about that,
yeah,
especially if they don't have sufficient income in the estate or assets in the estate to pay that tax liability, or they dispersed the assets too early before they knew that the estate would be on the hook for the RSP tax.
yeah.
So that's a great point you make, Gordon.
The other, I think, I guess, to kind of wrap up as far as best practices and pick up on what you said earlier, Jenna. So the summary would be you've got to file a tax return from January 1st to the date of death. And of course, if the person was behind on taxes, you got to file all the past taxes as well. So hopefully that's not the case, but that again is part of the responsibility. You got to clean up all the taxes right up to the date of death. For the period of time the estate is open and being administered, you have to file a tax return. Those are the T3 returns. And then ultimately at the very end, once all the returns are filed and you received a notice of assessment, you're in a position to request a clearance certificate. So one of the important aspects that an accountant can help with regard to dealing with taxes is to get you that piece of paper called a clearance certificate, right?
Yeah.
Because that is the piece of paper once issued, which prohibits CRA from coming against the executor for anything else relating to the estate. That's your clean bill of health, and you can rely on that to then complete the final distribution in the estate. So what typically happens is you'll do an interim distribution, depending on the size of the estate, if the only thing left is the clearance certificate, and make a reasonable holdback for any final taxes. But just recognize as part of this process, you want to get that piece of paper from CRA saying the deceased owes no more in taxes. And that's the protection there, that CRA is not going to come after the executor after a distribution to say, oh, you still owe some money, right? And that's where you got to be really careful that you don't distribute the estate in such a manner that you don't have enough money to pay that any amounts that would be owing, because that's usually the last creditor that has to be resolved, right, is CRA. Normally the other debts get paid fairly quickly, assuming there's money in the estate, of course. But yeah, it'd be important to get that final clearance certificate. And in order to get that, CRA is going to look at all the tax returns that have been filed and go back 3 years. So you want to make sure the accountant can go in and say, yes, everything is clean, everything is filed the way it should be. And so then that goes smoothly for getting that final clearance certificate.
Yes, I agree. And as a previous or a former professional executor, I've waited, a couple years for a clearance certificate before. So it can take some time, but it's definitely worth that, the weight in gold, as they say.
Yeah, I think typically we're seeing kind of in that 3 to 4 months would be a typical turnaround for a clearance certificate. But if there's any complexity, of course, that can extend much longer, or they take exception to something that has been filed. Well, now you have to resolve that. So the sooner you get those filed and get the tax returns filed, the sooner you get in a position to kind of wrap it up. But yeah, I guess the other theme would be know what your deadlines are. I think most people would approach this going, I have not the foggiest idea what those deadlines are. So the point being, go hire the professional and they'll tell you what it is. So you can mark it on the calendar, and you want somebody to say, here's a checklist of things that I need. Well, then you can go get that. Just figuring out what the cost basis is for stock portfolio can be very complicated, right? So you want somebody who can sift through that and help you with it, because that's protection. And that's, you're not expected to know all this, but you need to know what those deadlines are. You need to know what your obligations are. And yeah, it just makes sense. It makes sense to do it, right? Just had a conversation with somebody who regularly files tax returns and was somewhat comfortable with this, but even he said, I'm going to hire an accountant, right? Just so I have somebody who can in fact give me advice on this and make sure I'm doing it correctly. So even a professional who could do it themselves, that was an example where they recognize the importance of getting that outside advice. So you're not going to get pushback from the beneficiaries about hiring an accountant. You probably get pushbacks if you didn't hire the accountant, right? To say you're trying to do it yourself. So it's not a do-it-yourself project. It's complicated, and you want to get somebody who knows what, they're familiar with this, with these filing requirements, and can give you advice on deadlines and what would be required, and walk you through that. That'll give you that peace of mind to know you're doing that part of the administration correctly.
Yeah. Yeah, very true, Gordon. And it's fun always talking to you about estates, but even taxes even more interesting. So thanks for the discussion today. And for our listeners, thank you for listening. Please feel free to subscribe on wherever you listen to podcasts. And we look forward to seeing you and hearing from you next week. Talk soon.